Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Mike Wirth, the CEO of Chevron, joins us now for an exclusive interview. I am so glad that we're getting to speak with you, Mike. Thank you so much for being here with us.
You're welcome, Lisa.
So let's start about that. $1.99 a gallon. It might be great for a lot of people in terms of filling up their gas tanks. A real question around drill, baby, drill, and how much you're incentivized to increase production given the lower cost of oil.
Well, we make our investment plans on a long-term basis. We look at supply and demand well out into the future. And so the price of oil today can affect short-term financial performance of the company, but it really doesn't play as much into some of the longer-term investment plans as we look down the road, not really out the window, as we decide what the capital program looks like.
But how do you reconcile the two? Because you're doing a lot of exploration internationally. And to Lisa's point, prices are low and potentially are going to even go lower.
Well, exploration is a long cycle business. We just brought a project online in the Gulf of America last year where the discovery was made 20 years prior. And so the timeline between when you actually make a discovery, when you appraise that, and you ultimately develop it and bring it to market can be years or even decades. And so we really have to take that long view on the business. And, in the short term, we'll keep costs tight. We've guided to, industry-leading free cash flow over the next few years as we bring costs down, capital spending down, increase the synergies on the Hess transaction. So we're going to deliver strong financial performance through the cycle.
Based on what the IEA has said, recalibrated where they see oil demand growing, it was 2030, now it's 2050. OPEC says they had a rendezvous with reality, seeing that the world needs a lot more of this, a lot more fossil fuels. If outlook is so strong, should Chevron, should all of these big oil companies, should they be increasing more of that investment?
Well, on the IEA, even a broken clock is right twice a day. So they have finally acknowledged what we've long known, which is that the world will continue using oil and gas for many decades into the future. We are in that long cycle business, and the capital spending, Anne-Marie, has become more efficient in our industry. A decade ago, we were spending money on big projects. There was a lot of growth going on in shale at a relatively high cost structure, and the entire industry has found ways to standardize designs, simplify projects, and actually get more for every capital dollar that we spend. So the size of our capital spending doesn't necessarily correlate to the growth the way that it would have in years gone by.
When it comes to expansion, the U.S. government is backing this plan Iraq has to transfer Lukoil stakes to an American company. So it's really only you or Exxon. How are those negotiations going? Well,
I can't comment on commercial negotiations. What I will say is we've got a well-established reputation as a good partner, as a world-class operator in international locations. We're sought out as a partner in countries around the world. We've got a long history working in the Middle East, and we put a real premium on partnership, and that goes to every country we work with and every company we work with.
Can you talk about those assets, though? Do you think those would be good assets to the Chevron portfolio?
Well, we always look to strengthen our portfolio. Iraq is a country that's blessed with very substantial petroleum resources and some of the largest fields in the world. And so those are the kinds of things that we always look at.
You've been talking about the capital profile and investments and how it's become a lot more efficient to make the same kinds of investments and frankly, the same kind of output. Where is this efficiency coming from? Is it coming from artificial intelligence? Is it coming from just better technology and getting oil and gas out of the ground?
Yeah, so in shale, for instance, which is something the U.S. has been a world leader in, a decade ago, break-evens were $70 or $80 a barrel. Today, they're not even half of that, as we found ways to drill longer laterals, to optimize the spacing of wells, to complete wells at lower cost with greater production coming out of them. So it's a series of things. In the deep water, we've simplified and standardized designs, and what used to take $30 a barrel or more in terms of cost of capital capital to go into a project now has been cut in half. And so it's not driven by AI yet. I do think over time we're going to see technologies like that continue this path that we're on.
We're going to get to that in just a second. If that's the case, if you can get more, even at a break-even cost that's a lot lower, why has the rig count gone down so much? Why aren't there more rigs coming online given the capacity here in the United States?
Because we can drill more feet per day with a rig today than we could in the past. And so rig count is not nearly as interesting a metric as how many feet a day you can drill, how many wells you can complete in a period of time. And so we're getting more work done out of fewer pieces of equipment today.
You talk about how AI isn't delivering those efficiencies yet, the indication being that maybe down the road it might be the case. Where specifically are you thinking? And I'm saying at a time when Chevron's cutting staff, so are other people. Is this a headcount issue? Is this something else? How are you seeing it being deployed?
Well, I think we're still in the very early days of applying AI at scale in our industry. One of the things that's undeniable about AI is it needs lots of data. A company like ours has as much data as just about any company in the world. And so we've got decades and decades of geologic data, seismic data, operating data, all of which can be used to feed these models to optimize operations, to improve our exploration success, to squeeze more production out of existing assets. And so we see huge opportunities to run our business with smarter technology, get better decisions made faster. And so there's certainly a cost dimension to this, but I think the real opportunity is going to be about the productivity of our assets and our business.
You announced this project, the first of its kind, to provide natural gas-fired power for data centers. Do you expect to do more of these projects? And what's the update on this one in West Texas?
Well, certainly the demand for power has been talked about now for the last year or so as the constraint in the growth of AI. Data centers and the ambition for data centers at a scale we've never seen before has become a commonplace. The reality is we need large-scale power. What we're working on is off-the-grid power because it's also becoming an issue with electricity prices, and we're seeing this show up in consumer sentiment, in elections. Our approach is to develop gigawatt-scale power generation, not through the grid, but dedicated to data centers. We've got a project in a couple of sites, actually, we're working on in West Texas, where we've got a lot of natural gas. We've got large gas turbines, the largest in the world, being delivered starting next year. And we're deep into discussions with multiple customers that would like to site data centers to use this power.
You're at the center of a lot of politically very important conversations, not just when it comes to AI, not just when it comes to Lukoil assets, also Venezuela, the only American company left. Can you give us an update on either conversations with the administration, your team on the ground? What is the future of Chevron in this country as the president says maybe he's going to send troops there?
Yeah, I don't know what the president's intentions are. We've been in Venezuela for the last 100 years. Our presence there, we believe, is important for the local economy, the regional economy, the people of Venezuela. The Venezuelan oil is sought after by U.S. refiners, and we operate there in full compliance with all U.S. law and sanctions. We're in discussions with the administration to ensure that we stay in compliance, that they understand the value that our presence brings to America. And so, that's...
And you plan on being there for the long term?
Venezuela actually has more oil and gas resource than Saudi Arabia. It's right here in our hemisphere, very close to the Gulf Coast refining complex. And we've been there through ups and downs. And like many places in the world, we have to take a long view on our presence in countries like this.
You talked about succession yesterday at this conference. How are you thinking about that as you talk to the board? Is there something you want to get done before you hand over the reins?
Well, succession discussions begin on day one, I think, for most CEOs. It's part of a board's responsibility to be thinking about the next generation of leadership. I have a long list of things, some of which have been accomplished. I mentioned the Hess transaction, which was a big one for us earlier this year. We have laid out a plan for the next several years to investors last month that grows free cash flow, that drives significant return of cash to shareholders. All of those are things that I want to make progress on. But when the time is right for someone to follow me in this job, the board will make that determination, and I will happily hand over to.
Will you go right
person.
for landman?
Just 30 seconds left. Do you think that in 10 years, gas or oil is going to be more valuable?
Well, on an energy content basis, oil's got about 6 times more energy content per unit of volume than gas does. And so, they trade in sympathy with one another because energy is somewhat fungible. I think both of those commodities are going to be essential to the global economy. I think demand for both of those will be much higher than it is today. And I think you're going to see good companies in our industry still producing more of that and doing it in a way that keeps costs very affordable for the economy.
Stay with us. More Bloomberg surveillance coming up after this.
Julian Emanuel of Evercore staying bullish into 2026, writing earnings strength, fiscal and monetary stimulus, and a capital market cycle moving into higher gear are laying the groundwork for 750 at year end 2026. Julian, I am so glad to say joins us here. Julian, thank you for being here.
Good morning.
So what do you make of the yields rising this morning?
Look, the first thing is we have to step back and understand something, that bond market cycles are very long-legged things, and the 40-year bond bull market ended at the pandemic lows in 2020. And when you think of, and Anne-Marie, you just detailed all of the reasons that yields are going higher, and the answer is yes to every single one of them. You put it together, in our mind, if you think about it, it's almost remarkable that the confluence of the U.S. being the premier destination for capital has actually caused spreads against global bond markets to compress. If you had said to me Japanese 10-year yields were going to be close to 2%, I would have told you at the beginning of the year that U.S. 10-year yields would be close to 5%, and we're not there. But all of these pressures are building, in our mind, towards higher yields.
If we do get a hawkish Fed today, is that going to diminish some of the optimism that you have heading into 2026, or support it, given the fact that the Fed is looking at a rosier economic backdrop?
So that is the question that is really fascinating in our mind, and we're a little bit uncomfortable by this, incredibly staunch consensus that we are going to get precisely a hawkish cut that is going to be bullish for stocks in the near term. We actually think long term it is bullish for stocks because simply it shows that the Fed is cognizant of the inflation problem as well. But the other issue there, Lisa, is the labor market is about as clear as mud. I think whatever, it's not even mud. It's unknowable right now, and that's really the aspect of the flying blind that is probably going to weigh on markets.
Julian, what unnerves you about the hawkish cut consensus? Is it the hawkish part, or is the fact that people think that is going to be bullish for stocks?
No, it's actually the deep consensus. So what we've seen this year, and our survey team has really been front foot on this, particularly during the government data blackout, is that anytime we've had really, really deep consensus, whether it was going back to that week in April where our clients, 81% of them thought we were either in a recession or it was going to start in the second half, or going back to the end of October when a record 75% of our clients responded in our polling that the next 10% in the S&P 500 was up, and then you immediately had that 5% pullback. That's what bothers us, and the consensus around the fact that this is likely to be bullish. And frankly, if this was any other month than December, it probably would not be as sharp a consensus, but December tends to be a good month for stocks. We think there is potential for surprise here.
Like what? What's the surprise?
Well, look, if you look at last year, you had a hawkish cut at the December FOMC last year, and the market pulled back. It didn't derail the bull market in any way, shape, or form, but it made December an unexpectedly volatile month. And you add in the fact that you're going to get data employment data on the 16th. Who the heck ever heard of the Fed talking and then getting the data?
Agree.
It's ridiculous.
You're speaking Anne-Marie's language. She's saying, come on, move the meeting so we can actually get that data. It's not just the employment data. It's also a question around the big tech space and exactly what they are doing. I think about John Stoltzfus. He comes in every day singing, it's how you do the things you do. And it's sort of this question around Oracle, which reports earnings after the bell. How much are they, yes, planning for expansion, going to beat expectations, but continue building their debt pile in a way that seems not unsustainable, but potentially a little more precarious when it comes to capital markets?
Yeah, no, and actually from our point of view, the concern around the debt loads of these companies, this one in particular, is quite rational. If you think back to this whole talk about an AI bubble, which we don't believe we're anywhere near the end game yet at all in AI, but if you think back to the late 1990s, the concern was just a random throwing money at everything, everywhere, without revenues. And in that respect, having a little bit of capital markets discipline around a company that is assuming a bigger debt load is very, very measured, and it shows that people are not losing their heads. But our question is that when those earnings are announced this afternoon, is it more the sense that the AI bubble is going to pop? We think it might actually be more the sense that the fear bubble, as reflected by the credit default swap market, may pop.
In other words, the idea that people are pricing in the highest chance of some sort of default or demanding the highest amount of compensation for default from the likes of Oracle going back to 2009, that might have to diminish. I do wonder the Fed's role, putting these two stories together. What is the Fed's role in lifting the AI bubble? This idea that if the Fed is overly easy, and I say overly based on the economic conditions, what they might warrant, does that lead to an inflation of some of these valuations and, frankly, the debt profiles of some of these companies that raises your concern?
It certainly could. And we have said for the last several months that given this sort of extraordinary time that we're in, where earnings are going to be good, the economy's humming along, even with the questions around labor. But the point is both monetary and fiscal stimulus really do have the potential. We've said there's a 30% chance that you get a full-on bubble next year, which we define as 9,000 in the S&P 500, which I think is also why, on balance, the Fed is trying to remind everyone of the dual mandate in general. But again, the questions around the labor market are very, very intense.
Especially given Joel's data came out yesterday and just added to this confusion, given the fact that the headlines number came in pretty well. And then you saw the quits number coming at the lowest pace going back to May of 2020. So choose your own adventure. Is gold telling us something? Because I was looking at the moves since the last Fed meeting. And what stands out to me, 10-year yields, 30-year yields, and gold up 7% in that period of time. Are we getting a signal there about the path of travel right now in terms of the U.S.'s role, in terms of fiscal dominance when it comes to the U.S. dollar, and when it comes to just going forward, what people think about this policy?
Well, gold has really the last couple of years been a portfolio diversifier. And then from our perspective, you saw what we believe is a reasonably significant dollar top in the first quarter of 2025. So gold tends to trade better on that. I would say, frankly, gold has actually lagged the last month or two as silver has shot the moon. That to us says that there's probably a pause in the precious metals frenzy coming, into 2026.
Stay with us. More Bloomberg surveillance coming up after this.
Turning back to the Federal Reserve, President Trump reportedly planning to start his final round of interviews for the Fed chair in the coming days. The frontrunner, widely believed to be National Economic Council Director Kevin Hassett, who said there's, quote, plenty of room to cut. Joining us now is someone who disagrees with that statement, Lindsey Piegza of Stifel. Lindsey, you've been really vocal on the fact that you do think that inflation is very much a preeminent concern and is being underplayed by this particular Fed. How much do you expect that to come to bite the Fed when it comes to really yields, which is what we're seeing this morning.
Well, I think the Fed is well aware of the fact that inflation remains a very sizable problem. As we see, the majority of Fed officials have come out and spoken against, or at least questioned the need for further rate cuts. So there's a very clear divide among Fed officials right now. Some focused on the employment component, but still, as I mentioned, a majority concerned that we did not do enough the first time around to reinstate price stability. And now it becomes even more of a challenge for the Fed to get us back to 2%, having left prices well above that target level for so many years now.
Where is the inflationary pressure coming from, given the fact that people have seen rent prices actually come down, not just disinflation, but outright deflation in a couple of rent metrics? And we are seeing pretty contained price increases, certainly during the holiday season, even on consumer goods. So what's going to drive this?
Well, there still is some improvement. We have seen some improvement, as you mentioned, in these pockets. But when we look at the cost of services, this is still going up consistently over 0.3 on an average monthly basis. So that's continuing to fuel these overall annual inflation numbers up near 3%. Remember, it was never about getting us down from 8 to 6 to 4, close to 2%, but back to 2% on a sustained level. And the Fed failed, as I mentioned, to really bring us to that sufficiently restrictive level the first time around, stopping short at 5.5. And so now the Fed continues to contend with above trend price pressures.
Does this get worse when the president gets his pick for the Fed chair?
I think the Fed is going to have more of a lean to the dovish side. There may be more of an inclination to err on the side of additional rate cuts as opposed to holding steady, moving to the sideline, waiting for the data, depending on who takes the lead at the Fed. But remember, all of these members are pro-growth, pro-market economists. They're looking to support the economy. They're looking to meet the Fed's dual mandate, and they will base policy appropriately to achieve that legally mandated goal.
When you look at potentially inflation next year, where is that coming from? Is that coming from like almost a self-induced crisis in Washington because the one big beautiful bill and maybe these $2,000 dividend checks?
Well, so this is one of the biggest concerns. Right now we're looking at inflation and we're saying, okay, there's not necessarily a tremendous amount of upside momentum that we're concerned about. But as we turn the calendar page, if we see a stronger growth profile than expected, right now, according to the Atlanta Fed, we could see Q3 GDP up over 3.5%, much stronger than what the Fed had anticipated. We're still seeing a very spendy, solid consumer as we go into this holiday shopping season. And my biggest concern is businesses drawing down inventories, eating into profit margins. If they begin to pass through more of these tariff-related or other policy-related costs onto the end consumer, any one or a combination of those factors is going to drive inflation higher. So we can't get ourselves in a position where the Fed eases dramatically and then quickly we have to reverse course because inflation is taking off up near 4% or beyond.
I just feel this but coming in. Yes. All these people who are listening to this saying, but that GDP number was really driven by data center investment. And what we're seeing right now, potentially next year, is greater efficiency, greater productivity that could fuel both growth but also a disinflation. That was
there
really
is disinflation on the AI side, absolutely. Increasing productivity, increasing efficiencies, as you mentioned. But there's also an inflationary component, too, driving demand higher for these AI services, as well as this sizable energy component, driving higher demand for data centers. So it's not necessarily a clear-cut argument that AI is going to, or other technologies are going to drive inflation down. There still are a lot of question marks. And if we factor in tariffs, if you factor in consumer and growth prospects, I think the risk still remains to the upside.
Where's the political risk here in the case that you just made? You talk about how it can be inflationary, and then you think, okay, energy costs. And we are going to be speaking with the Chevron CEO, Mike Wirth, later on. It should be a great moment for energy costs, at least from the producer side, because you should see them going up because of how much energy is in demand.
Well, we have seen energy go up over 40% in just the last 5 years.
But we haven't seen oil prices go up. And this is sort of the question of at what point can you factor in government interference in trying to skew prices to the downside because of some of the political concerns, leaving a sort of subdued inflation, even if the supply-demand dynamic might otherwise signify something else?
Well, there will be pressure on the administration to step in. As we know, the fastest way to derail the American consumer is sustained heightened energy prices. And that will show up in the polls, be it the midterms or other. And so there will be a lot of pressure on the administration to step in, not necessarily with a long-term solution, but certainly with some short-term reprieve.
Well, that's with electricity. Is it balanced out with the fact that the president last night was talking about gasoline $1.99? So then I looked, and actually there is a gas station in Oklahoma that has a gallon for $1.99. In Colorado for $1.69, the Gas Buddy has everyone mapped out. And I said, wow, they really are that low, below $2 a gallon. But the issue people have at home is electricity prices.
Right. And
do they negate each other?
For the household balance sheet, the average consumer will look at where they're allocating those funds, be that to the gasoline tank or be that to the household energy bill. And so if one is improving and the other isn't, we're still going to feel that pressure as normal consumers, normal spenders.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.